In this video, we're going to have a look at growth and high yield stocks. Are you a growth investor? Growth stocks are stocks that have a history of growth and great growth potential over the next few years. This is growth in stock price. Examples of growth stocks include Amazon, Alphabet, Meta, and Tesla. These are innovative companies that have caused market disruption, have a large moat, and have always tried to grow and improve their products or services. Tesla arguably having the biggest growth potential if it executes its projected plans with full self-driving and the Tesla bot. Unfortunately, these companies do not pay dividends. They may do in the future, but this could be many years away, if ever at all. If you purchased Tesla shares at the beginning of 2020, it would have cost you sub $30. In November 2021, it hit a high of $407.36. These prices are split adjusted after the 3-to-1 stock split. This is a 1,257.86% increase. It has dropped by 50% since then to 2015 today, which is still a 616% increase. Now that is a fantastic return, but hard to predict. A lot of analysts, including Jem Cramer, said not to touch the stock. In his words, don't even rent it. The investors that bought and held did really well, and for some that sold at the top and bought back later, even better. Now, what if you'd have bought the stock at the high of $407 and when watched it drop to $215? Would you have sold out? I can imagine a lot of retail investors have panicked and taken a loss. Also, a lot will have held out until it gets back up there. It is difficult to time the markets. It could take a few years for you to get back a solid return. That is a sacrifice you take, the risk reward. If you'd have bought Alphabet at the beginning of January, it would have cost you around $68. It has hit a peak of just over $148. Today it is $85.90, again split adjusted after the stock split. Given the global events, this could easily drop further. It is similar with Amazon. Just over $93 in January 2020, it is now just over $90. Meta in 2020, just over $208, now $89.20, so over 50% down. Very volatile indeed. As a dividend investor, you get a return on investment even when the stocks are down. There are growth stocks out there like Microsoft and Apple which give you the best of both worlds. Arguments can be made that the biggest growth for both companies have already happened, which is true in the sense that trillion-dollar companies cannot easily 10x their growth. The growth of Apple in the early days was down to the vision of Steve Jobs. He did incredible things with Apple, turning it into a juggernaut, always innovating, turning their competitors into a bit of a joke. Remember the Mac versus PC adverts? Macs were cool and PCs were outdated, nerdy, and generally seen as an inferior product. He built a cult following. The annual product release conference in September was a big tune-in event and had general excitement around it. The iMac, iPod, iPhone, iTunes, and App Store were game-changing. Since the passing of Steve Jobs in 2011, it has never been the same. The new products releases feel a little bit lackluster and tend to be general updates and improvements rather than anything revolutionary. The Apple Watch is really the only new product since his passing. His influence still lives on though. The integral ecosystem is their biggest asset. Once you are locked in, it's very hard to leave. The thought of switching everything over feels like too much of a headache. The products are easy to use and still feel very premium. The future looks bright. They have Apple Fitness related products in the pipeline, they have invested heavily into augmented reality, and have future releases of AR glasses coming. Also, rumours of an Apple car in the pipeline could really bring back the excitement and buzz to the company. Apple have increased their dividends by 4.5% recently, from 22 cents to a measly 23 cents. That is a whopping 0.7% yield. Apple's payout ratio is less than 14%. At the beginning of 2017, you could have picked up Apple sub to $30. It is now over $150. In the past 5 years, the stock has grown by 261%, so you are getting gains in price plus a small dividend that is slowly increasing over time. Microsoft had a monopoly with its operating system and Office software for many years. It was industry standard and had no real competition. They lost their way a bit and Apple took their crown in 2011's Q1. For the first time in 20 years, Apple was king. It has branched out into gaming, entering the gaming market with Xbox and going toe-to-toe with Sony's PlayStation. It has made numerous acquisitions which has helped the company grow, including LinkedIn in 2019. They purchased LinkedIn for $26.2 billion. It generated just over $10 billion last year in revenue and has been increasing revenue year on year. A wise purchase indeed. The tech company is experiencing decelerated growth in its revenue, which is disappointing the investors. That, and also with the down market trend, is keeping the stock price suppressed. If we look at the breakdown in revenue, they brought in just over $203 billion, a 15.22% increase year on year. We can see that their cloud service is their biggest source of revenue, generating over $60 billion. The cloud sources is clearly growing. Microsoft has a clear roadmap ahead and a clear vision of where it needs to be to continue to grow. They even recently increased their dividend by nearly 10% from 62 cents to 68 cents a share. The dividend payout ratio is 29.29%, so they clearly have funds to increase it again if they wanted to. In the past 5 years, Microsoft has grown 180.33%. In 2017, you could have picked up a share for around $70. It is now $235.87. The market has been very volatile over the last couple of years. It has had a high of 336, and it will get back there. It's just a matter of time. Now, growth versus yield with dividend stocks. Now, this is a difficult one because, especially when you're first starting out, you want to build up the amount of dividend income coming in so you can invest in more stocks. The higher the yield, the more money you're going to have coming in. Now, this might be short-term thinking, which is fine and works depending on your circumstances, but long-term, some of the growth stocks outperform the high-yielding stocks by a significant amount, which far exceeds the dividend payments which you would have received in that same time. What I do is like to have a mixture of high-yielding and growth ones. Like everyone else, I want to have the dividend payments coming in regularly and increasing regularly. I have 27 holdings, 14 of these all pay over 4%, including some big hitters that pay way above this, including Main Street Capital Corporation, Verizon, AT&T and Intel. But to counteract this, I've got Apple, Microsoft, PepsiCo, Johnson & Johnson, Procter & Gamble. These are stocks that have low yield but provide more stability in terms that you know they're going to be around for decades. Plus, they will all definitely increase significantly in price. Plus a bonus, they have all increased their dividend payments. I've talked about Apple and Microsoft, but if we look at Johnson & Johnson, over the last 5 years the stock price moves up and down, but in an upward trend. If we zoom at the maximum time period, we can really see how much it has grown. On top of this, they have regularly increased their dividend payments. If we look back through the years, we can really see how much it's grown. The same with PepsiCo. Over the last 5 years, relatively upward trajectory, and Procter & Gamble as well. These also increase their dividends regularly. How diverse are your portfolios? Please let me know in the comments what you have been invested in. Thanks for watching. As always, you should do your own due diligence when investing. These are my own personal views. If you enjoyed the video, please like and subscribe. Here are 2 more videos you might be interested in.